Hey everybody, welcome back to the Optometry Money Podcast, where we're helping ODs all over the country make better and better decisions around their money, their careers, and their practices. I am your host, Evon Mendrin, certified financial planner and owner of Optometry Wealth Advisors, an independent financial planning firm just for optometrists nationwide. And thank you so much for listening. And if this is the first time you are joining the podcast, welcome to the podcast. And in today's episode, I want to have another episode all about important student loan updates. I feel like it wasn't too long ago I did an episode about payments restarting and recent updates and things we're keeping an eye on. And now, just before the July 4th holiday, we had a whole list of new announcements and things that we've been waiting on finally come to be finished and finalized. So today I want to talk about several updates that came out of the last few weeks, talk about the Supreme Court ruling and what that means for loan forgiveness, talk about the new income-driven repayment plan that is now finalized. We'll dive into that. Some of the details around other income-driven repayment plans that are now going to be limited or have no access in the future. We'll talk about reminding you about the IDR account adjustment or IDR waiver that's happening at the end of the year. And then lastly, I want to talk about really important news for Kaiser Permanente optometrists or optometrists in California or Texas at similar nonprofit hospitals or healthcare systems, because there's some really big PSLF news that is out, or really updates that are live this month in July. So I want to talk about that. And hopefully this is the last big student loan update episode that I'll have for a while. Hopefully things sort of settle down. And I think it will be, because a lot of the stuff we've been waiting for over these last really year or two, last couple years, have finally sort of come to an end. So let's dive in here. Just before the July 4th holiday, I think it was literally that Friday before, the Supreme Court finally announced its ruling on the student loan forgiveness case. And this is for federal student loans, right? So if you've refinanced your loans out of the federal loan system, this didn't actually pertain to you. You're just continuing to aggressively pay down those debts as best as you can. But for those within the federal loan system, Biden had announced, I forget if it was 1 or 2 years ago. The last couple of years all sort of blend together for me, but he had announced, or his administration and the Department of Education announced a federal loan cancellation program for either $10,000 or $20,000 of federal loans. And this applied not only to borrowers, but also current students as well. And this eventually made its way to court, which was, I guess, not surprising. Through a few different cases, one of them that made it all the way through was really the state of Missouri on behalf of Mohila, the servicer. And the decision was really about, did the Biden administration and the Department of Education have the authority to forgive or cancel this debt without an act of Congress? And finally, as that has made its way through the court system all the way up to the Supreme Court, just before the July 4th holiday, as bad news usually comes out, the Supreme Court ruled that the administration and Department of Ed did not have the authority to forgive debt like in this manner without an act of Congress. And for me, this was sort of expected. Everything I heard about the court case and the arguments, this seemed like the likely way that it would go. But if you've been hanging on to $10,000 to $20,000 of federal loans and you have simply been waiting for this to be resolved, you probably can pay that off and just continue on with your life. And just after that, immediately, basically after that announcement, President Biden announced an effort to get this debt forgiven through the Higher Education Act. But it's really unclear how this is going to be any more successful than the previous efforts. So it seems to me, and everything I hear and listen to, this is likely just a show of politics, that the administration is doing whatever it can to get student loan forgiveness, or in sort of a game of chess to take the focus off of the more generous SAVE plan, which is something we'll talk about next. because immediately after, so almost immediately after the Supreme Court decision and the announcement to try again for forgiveness through the Higher Education Act, the Administration and Department of Education also announced final regulations, final rules for the brand new IDR plan, the SAVE plan. And this was something that was announced, I think, back in 2022. We saw proposed regulations, meaning that these are sort of the proposed new rules about how this new plan would work. It was really a modification of the current revised pay-as-you-earn plan. There are technically 5 income-driven repayment plans. The most recent one was revised pay-as-you-earn. And so this new plan was going to be a modification of that. And now it's sort of been officially rebranded to the SAVE plan. And a lot of the finalized rules are going to be much of the same as what we saw before. And this is going to be a much more generous income-driven repayment plan in a few different important ways. So the first thing that we're going to see is that you are, in this plan, you're going to be allowed to file taxes married filing separately if you're married and exclude your spouse's income. This is something that you could not do on revised pay-as-you-earn. No matter what, you had to include your spouse's income. On revised pay-as-you-earn, you could do that under pay-as-you-earn. You could do that under IDR. So this is an enhancement in that it's going to allow you to file taxes separately and exclude your spouse's income. Why would you do that? Well, by doing so, you can potentially lower your student loan payment calculation for each month as you recertify your income every year. And a lower payment will mean that there is lower amounts paid into the debt. And if you are going for forgiveness, that means there's more amount of that debt forgiven at the end. So filing taxes married separate allowed you to sort of maximize the way that you are preparing and planning towards going for some type of forgiveness, whether it's PSLF or income or long-term forgiveness over 20 or 25 years. And what's really interesting about that is if you are in a community property state, the way that your tax return will handle your community property income, so your household income, is that it will take both you and your spouse's income and then spread it out, divide it evenly between the two of you. So it'll chop your household income in half, which is great if you're the higher earning spouse. You have on your tax return lowered your income so that you can present that tax return when you are recertifying your income, which then lowers your monthly payments, which then potentially increases the amount that's forgiven, right? So that's an interesting planning point. If you are the lower earning spouse, especially if you are the lower earning spouse by quite a bit, or if your spouse earns a considerably amount less than you, you can still use your spouse's pay stubs as alternative documentation of income and use your spouse's lower pay to certify income for his or her loan calculation. So there's a lot of different things you can do for certain situations where you can file taxes separately and have those payments adjusted based on how you show your income. And it would have to make sense, of course, from a tax planning standpoint too. So it would need to be matched with a tax projection and to see whether the tax impact didn't outweigh the student loan impact. So that's the first thing, is that you can now, on this new SAVE plan, file taxes separately and exclude your spouse's income. However, there's a change now that happens across all of these income-driven plans, in that if you do file taxes separately, you also have to exclude your spouse from the poverty line amount when you are calculating the benefit. Essentially, you can't double dip, right? If you remember how income-driven plans calculate your student loan payment, it starts with your income. They subtract out an amount for the poverty line amount, and it's usually a percentage of whatever that poverty line amount is for your family size, so like 150%, for example. And then what's left there is called your discretionary income, and then you multiply your discretionary income by a percent. Right now it's 10 or 15%. So you can file separately and exclude your spouse's income, but you can't also exclude your spouse or you can't also include your spouse in that family size. So there's no double dipping there. Essentially, your family size there will be whatever it is minus one. The next thing is that it's going to enhance the payment calculation in a couple important ways, which will ultimately lead to lower monthly payments. The first thing is that it will multiply the poverty line amount that is subtracts from your income by 225% or 2.25 times instead of 150%, which means that more is subtracted from your income, which means that your payment will be less. It's also going to multiply your discretionary income to get your payment amount by a weighted average of 10% for your grad loans and 5% for your undergraduate loans. So for example, if 80% of your loans were graduate loans and 20% of your loans are from undergraduate, then you would multiply your discretionary income by 9% instead of the current 10% or 15% under the old IBR plan. So in those two ways, it's going to adjust the way your payment's calculated and likely lead to a lower payment calculation. And let's take a look at some examples here. So let's say that you are single and your income is $100,000. Maybe you're taking advantage of those pre-tax 401k accounts, so your income is $100,000. Your loan payment under the old IBR plan, so if you had taken out any student loans before 2007, your payment under the old IBR plan would be $976 a month. Your payment under the Pay-As-You-Earn plan or new IBR plan would be $651 a month, and your payment under the Save plan would be $503 a month, roughly, give or take a little bit. So, right, so you're going to see that payment decrease. What about if you're married? So let's say that you still earn $100,000. You're married and you're filing taxes separately, and you have 2 kids. So you're only going to include your own income in the calculation, and now your family size has increased to 3 to increase that poverty line amount. So under the old IBR plan, your payment would be about $783. Under Pay-As-You-Earn and new IBR, that would be about $522. Under the new Save plan, your payment would actually be $330 a month. So for families with a larger family size, there's interesting scenarios where forgiveness might actually make more sense than it did before. So in any case, just whatever you're doing, always look at the math whenever you're deciding which student loan approach to take, whether it makes sense to pay down your loans to zero and to do so aggressively, whether it makes sense to go for some sort of forgiveness, or whether it makes to take a blended approach of the two. Just look at the math for your own situation. And please, if your federal student loan balance is above and beyond your annual income or your expected annual income, especially if you're looking 1.5 times or 2 times, 2.5 times your income, please look at the math behind forgiveness and see if it makes sense. The other big change that's happening is that there is an elimination of or a waiver of unpaid interest under the Save plan. All of the different plans have their own sort of unpaid interest subsidies. Some a little bit more than from others. For example, Revised Pay-As-You-Earn had a bit of a higher subsidy than Pay or IBR. But this new Save plan will actually waive 100% all of the unpaid interest. If your payment amounts are lower even than the amount of interest accruing or charged to your balance, all of that unpaid interest is waived, right? So you're not going to worry about unpaid interest accruing. You're not going to be worried about that negative amortization that happens if it's capitalized into your principal balance. So all of that unpaid interest is waived, which makes it even more interesting, especially if you are just graduating, if your income is pretty low in those first couple of years, especially if you're only working for part of a year, that first year, and you want to use that cash flow to save aggressively for a goal like practice ownership. Well, starting out in the Save plan can potentially be a pretty big benefit to you. You can have really low payments early on. None of that interest that's not paid, or I should say none of that unpaid interest is going to accrue and hurt you later on. And you can switch and aggressively pay that down when you're ready for it. Or you can even take that saved cash balance and apply it in a lump sum towards your debt. So it sort of removes some of the risk of starting out in an income-driven plan and then changing course later on. Let's talk about the timeline to implement. So when is this new plan going to be available? Well, First, let's say that if you are already on revised pay as you earn, it's automatically going to be converted to the new save plan with the new features. So there's nothing you'll need to do. Officially, the full plan and all of its features are going to be available next July 2024. However, certain features, certain parts of it are going to be live at the end of this month, July 2023. So before your payments actually start. And that's going to be the elimination of unpaid interest accruing, the 225% of the poverty line amount, and the ability to file taxes separately. Those three parts of it will be available right away. Now let's talk about some future plan changes and limitations. And it seems like the intention here is for this new save plan to sort of become the one plan to rule them all, right? They're sort of tilting the board so that everyone's sort of sliding towards that direction. And you will soon have limited or no access to certain existing income-driven repayment plans. Specifically, after July 1st of 2024, so after July 1st of next year, you're no longer going to have the option to enter into pay-as-you-earn unless you were already on the plan. If you're on the plan already, they're not going to take you off. But as soon as you exit it, or if you are a new graduate at that point, you're not going to be able to enter into the pay-as-you-earn plan, which leaves some important decisions to make over the next year. If you were eligible for pay and you had your first student loans taken out after 2007, you have to think about, should you go into pay-as-you-earn, where you're going to receive 20 years of forgiveness instead of 25? Because one thing I didn't mention is that under the new save plan, if you have any graduate loans, you're still going to have 25 years until forgiveness. That wasn't adjusted. So you're going to have to think about, should you get into or stay in pay-as-you-earn and have a slightly higher payment with a little bit worse subsidy for unpaid interest in order for you to get that 20 years of forgiveness? Or do you want to enter into save and go for that 25 years of forgiveness with likely lower payments? That's a decision you're going to have to weigh carefully. And I don't know if there's going to be an easy answer to that. It's just something you'll have to think about a lot. Those extra 5 years can make a pretty significant difference. And especially if you're going for PSLF, if you're working for a nonprofit, the VA or government system, academia, or even for Kaiser or similar healthcare system or hospitals, as I'll talk about a little bit. If you're going for PSLF, you may want to stay on pay-as-you-earn because there is a cap on your payment to where it can't go higher than what your 10-year standard payment would have been when you first entered repayment. Revised pay-as-you-earn or now save, there's no payment cap, so your payment's going to go as high as your income will take it. And you also can't enter into pay or income-based repayment, IDR, if your payments are going to be that high. So that's going to be a decision you have to weigh over the next year. They're also going to limit your ability to leave the save plan and go into the new IBR plan, which is almost identical to pay-as-you-earn. And you can't leave save and go into the new IBR plan after you've made 5 years of payments in the new save plan. And what they're trying to do is avoid allowing you to switch into new IBR, which is available to borrowers that are new borrowers, meaning you're taking your first student loans after July of 2014 and doing that in the 19th year and then getting forgiveness in the 20th year. So essentially, if you are in save for the long term, you're going for 25 years. That's basically what they're trying to do. Which is something that you'll need to keep in mind. Do you want to enter into new IBR? If you're eligible for it, again, have those slightly higher payments, keep that payment cap, and get forgiveness in 20 years, or are you going to stay in save and go for 25 years? One other thing that was announced as a part of that is that there is a payment ramp-up period. So essentially, what's essentially an additional 12-month forbearance. So what's happening is that there's going to be a 12-month period between October 1st, when your payments are restarting, and September 30th of 2024, where during this period, although your payments are going to be due, technically, missed payments are not going to be considered delinquent, or they're not going to be reported to the credit bureaus or placed in default or referred to debt collection agencies. So you have what's effectively another 12-month forbearance. Interest will probably accrue, and it's not going to be counting towards any type of forgiveness, but something that you may be able to use strategically if you expect your payments to be lower in the future with changes in income. Maybe that's something you can use to your advantage. Next thing, I just want to give a reminder to you about the income-driven repayment account adjustment, or the IDR waiver, that's happening after the end of the year. And so this is something that's trying to give broad credit towards past payment history, towards either PSLF or long-term forgiveness, and that the credit's pretty broad. They're going to give you credit towards basically repayment status in any type of loan, in any repayment plan. They're also going to give you credit for extended forbearance, so 12 months of consecutive time in forbearance or 36 months of total forbearance they'll give you credit for. And they're also going to give you credit for months before you consolidated your federal loans, which is a super common. I mean, there were a lot of common stumbling blocks that if you accidentally did them or did them not knowing what was happening, you lost credit towards these forgiveness programs. And so they're sort of reversing that and giving you credit, pretty broad credit towards both PSLF and long-term forgiveness. So keep that in mind, that that's something that's happening after the first of the year. What you would have to do, though, if you have FFEL loans, is that you would have to consolidate your loans in order to get credit for that. And you'd have to do that before the end of this year, before December 31st. So keep an eye on that, look into that and see if that's something that's going to benefit you. Keep track of your qualified payments towards these forgiveness programs as these adjustments unfold over the next several months and then over into the early next year. One more thing I want to talk about, and this is a pretty big piece of news if you're someone that this impacts, is that if you are an optometrist at Kaiser Permanente or any similar nonprofit hospital or healthcare system, specifically in California or Texas, you're now eligible for public service loan forgiveness. So this is huge news. So historically, states like California and Texas had laws that didn't allow doctors to be directly employed by the nonprofits, right? So these, if you're Kaiser or some similar hospital, some similar healthcare system in California and Texas specifically, they were nonprofits, but you as the doctor, you as the optometrist, couldn't be employed by the nonprofit directly. You had to be employed by this for-profit arm that provided services for the nonprofit. And because your employer was a for-profit, that meant that you were not eligible for public service loan forgiveness, which is, I guess, pretty dumb if you think about that. Like, there's no reason that should keep you from qualifying. But so as of July 1st, new rules for PSLF have kicked in, and now if you are an employee of Kaiser or a similar entity in specifically California or Texas, you are now falling under the definition of who works for a qualifying employer. So even though you work for this for-profit entity, you're now going to qualify for PSLF. And I don't see specific language that would say this is retroactive, meaning that would look at past payments and give you credit, but I believe that it will be, which is huge news, right? So this is something that has caused a lot of doctors to probably refinance a pretty big amount of debt because they felt like you had no other options, or you're trying to aggressively pay down your debt because you felt like you didn't have the option of PSLF. Well, now this is pretty substantial news. So please share this news with your fellow ODs so that people are aware of this. So if you're employed at one of these entities, please do not rush to refinance your loans until you've had a chance to review whether PSLF makes sense for you and whether you're going to stay in that employer for the long term, for at least those 120 payments. You'll need to submit PSLF employment certification forms in order to get that employment certified and to get those payments counted. And you'll want to track your qualifying payments after that's done. I've seen that the paper form that you can get from studentaid.gov is updated to account for this. Not sure if the digital version is updated just yet. If you've already refinanced, what should you do? Well, first, I just want to remind you that you had no way to know this was coming. at the time that you made that decision. And you probably made the best decision that you had with the information that you had at the time. And this is just a case where you have to keep in mind and think about the process over the results, and that you followed the right process and the results happen because something outside of your control happened. So remind yourself of that first. However, if you refinanced during the COVID freeze and you think you can benefit from this, you're still working for Kaiser or a similar entity and you think you can benefit from this, it doesn't hurt to go for a Hail Mary. What do I mean by that? Well, we know you can ask for a refund of payments made during the COVID freeze. You could do so even if you paid off the balance in full. So I would consider calling your federal loan servicer at the time, whoever that was, and asking for a full refund of all of the payments made during the freeze, including the full payment made to pay off your loan for the refinance, as if it were a payment that you made to pay off the balance. In that way, you can re-enter the federal loan system and potentially be eligible for this. So I feel like it's a pretty low probability that it would be successful, but it doesn't hurt to try. And I know of at least 2 cases where the borrower was able to successfully get the refinance loan back. So this is a Hail Mary that if this is something that can change your life, I think it doesn't hurt to go for it. So hopefully that helps. Tell your fellow ODs about this. We have a huge amount of news coming out here. Hopefully this is the last big update episode I'll do for a while. Reach out if you have any questions about anything I've talked about today, or if you want a student loan consultation or talk about my services for optometrists, and student loans are always a part of that. Reach out to me. You can reach out to me by just simply emailing at Evon, EVON, at optometrywealth.com. You can check out all the show notes and resources I mentioned in this episode at the Education Hub on my website, optometrywealth.com. And while you're there, hey, feel free to schedule a no-commitment introductory call. And keep following the podcast. I've got some great episodes coming up. Over the next 3 episodes, I've got a series coming up on different financial planning decisions you need to think about and plan for if you are preparing for getting into practice ownership. And so it's a 3-part series that'll talk about what you need to think about and plan for leading up to practice ownership. What you need to think about. Number 2, what you need to think about in the early years of owning that practice or even buying into that practice. And what you need to think about as you have a more established, mature practice with increasing profit, increasing cash flow, increasing complexity. So that's coming up. After that, I've got a really great conversation talking about how to look at the financial and operational health of your practice through the lens and through the eyes of a CFO. So I've got a really great conversation coming up. So hopefully you'll keep following along. Really appreciate your time today. We will catch you on the next episode. In the meantime, take care.
Want more resources to help master your money? Check out the Education Hub on Evon's website at optometrywealth.com. Evon Mendrin is a certified financial planner and owner of Optometry Wealth Advisors, a California registered investment advisor. All opinions of Evon and his guests are their own. This show is for informational purposes only and should not be relied on for specific investment, legal, tax, or other decisions. Clients of OWA may own securities mentioned on this show.